Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hammond, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're diving into some significant news in the Canadian mortgage landscape for 2024. These developments could provide a breath of fresh air for both homeowners and first-time buyers. The Canadian government, alongside the Bank of Canada, has announced revisions to mortgage rates and policies that aim to make homeownership more affordable, especially in high-cost cities like Toronto and Vancouver. The Bank of Canada has been proactive in adjusting its policy rate, which now stands at 4.25% after 3 consecutive cuts in 2024. This marks a notable decrease from its previous peak of 5% in 2023. These rate cuts are designed to alleviate some of the financial pressures on mortgage holders with variable rates and to stimulate economic growth by reducing borrowing costs. This is particularly beneficial for those with adjustable rate mortgages, as they can expect lower monthly payments. For example, a homeowner with a $667,000 home and a 10% down payment saw their payments decrease by about $70 following the latest 0.25% rate cut in September 2024. Moreover, the Canadian government has introduced several key policy changes to further support home buyers. One of the most impactful changes is the increase in the insured mortgage cap from $1 million to $1.5 million, effective since December 15, 2024. This change acknowledges the rising housing costs in major urban centers, where average home prices frequently exceed the previous cap, making it easier for buyers to qualify for insured mortgages with lower down payments. Additionally, the availability of 30-year amortization periods for insured mortgages has been expanded beyond newly built homes. As of mid-December 2024, all homebuyers can access these longer terms, which can reduce monthly payments by around 9% compared to the standard 25-year amortization. This is particularly advantageous for buyers in expensive markets, easing the financial burden and facilitating market entry. Another significant policy shift is the allowance for borrowers to switch mortgage lenders at renewal without undergoing a new stress test. This means that insured mortgage holders can now shop around for better rates without requalifying, promoting healthier competition among lenders, and potentially lowering costs for borrowers. These changes are expected to have a broad impact on the housing market. First-time buyers may find it easier to enter the market due to lower monthly payments and increased access to insured mortgages. Current homeowners with variable rate mortgages are already seeing some relief from the interest rate cuts. Meanwhile, real estate investors might find new opportunities, particularly in the pre-construction market, thanks to the extended amortization options. According to recent research from the Bank of Canada, a significant number of Canadian homeowners might experience an increase in their mortgage rates when it's time for renewal. Despite the notable decline in interest rates throughout 2024, approximately 60% of outstanding mortgages are set to renew by the end of 2026. Of these, around 60%, which translates to roughly 40% of all mortgages in Canada, are projected to face higher rates. The central bank points out that many of these borrowers initially secured their loans when interest rates were near their lowest. Consequently, some borrowers may encounter a substantial payment shock. However, the Bank of Canada highlights that many of these homeowners have some flexibility to manage these potential increases. This is partly due to having paid down their principal over the years, as well as potential increases in their home's value, which could provide refinancing opportunities if necessary. Interestingly, the research indicates that those with short-term fixed-rate mortgages, particularly those taken out in 2023 or 2024, are less likely to see significant payment hikes. This is because these rates were already higher when these mortgages were originated. The findings stem from a Bank of Canada paper that utilizes new data from the Office of the Superintendent of Financial Institutions, covering about 80% of Canada's $1.7 trillion mortgage market, including residential loans and home equity lines of credit from federally regulated lenders. The data also shed light on some other insights, such as the fact that 12% of fixed payment variable rate mortgages are currently in negative amortization. This means that the payments do not fully cover the interest, causing the loan balance to grow. However, as rates decrease and borrowers renew, many are resetting to their original contracted amortization periods, normalizing this trend. Another key insight from the data is the growing preference for shorter-term fixed-rate mortgages. In 2024, 71% of newly originated mortgages had fixed rates with terms under 5 years, largely chosen by borrowers with low loan-to-value ratios. This is a significant rise compared to the 38% of all outstanding mortgages with similar terms. Meanwhile, the share of variable rate mortgages in new originations dropped to just 10%, compared to 20% of all outstanding mortgages. The data further reveal that younger borrowers and first-time buyers are more likely to hold high-ratio mortgages, with loan-to-value ratios exceeding 80%. These borrowers tend to have smaller down payments and higher debt loads, making them more vulnerable to rate increases and market fluctuations. In contrast, low-ratio borrowers are generally older, with higher incomes and greater resilience to rising rates. Although high-ratio mortgages have seen a surge in recent originations, low-ratio loans still represent a substantial portion of the overall market. Lastly, the Bank of Canada notes a trend of newer borrowers taking on larger mortgages. As of September 2024, the median outstanding principal balance for mortgages originated between January and September was $344,000, significantly higher than the $245,000 for all mortgages. This increase is driven by rising home prices and is reflected in the median appraised value of homes at the time of mortgage origination, which was $600,000 for 2024 originated mortgages compared to $485,000 for all existing mortgages. The Ottawa real estate market concluded 2024 on a high note, with a notable increase in activity during December. The Ottawa Real Estate Board reported a 7.9% rise in home sales compared to the previous year, totaling 613 homes sold. Although these sales figures were still 6.8% below the 5-year average and 2.7% below the 10-year average for December, they signaled a significant upturn. For the entire year, Ottawa saw total home sales reach 13,526 units, marking an 11.8% increase from 2023. Paul Tsan, the president of the Ottawa Real Estate Board, described 2024 as a year of wait and see. He noted that the year ended with promising signs of improved market conditions, fueled by factors such as consecutive interest rate cuts, raised insured mortgage limits, and extended amortization periods. Chan highlighted that while it's early to fully gauge the impact of these measures, challenges related to affordability and supply continue to persist in the market. In December, the average non-seasonally adjusted sale price rose to $663,781, a 4.4% increase from the same month in 2023. The MLS Home Price Index Composite Benchmark Price, which accounts for seasonality, increased by 3.8% year-over-year to $645,800. Breaking down by property type, single-family homes experienced a 3.7% price increase, reaching $729,300. Townhouse and row units saw a substantial 11.3% gain, with prices climbing to $533,200. However, apartment prices decreased by 2.5%, settling at $404,400. The total dollar volume of home sales in December surged by 12.7% year-over-year, reaching $406.9 million. For the full year, the sales volume amounted to $9.2 billion, a 13.3% increase from 2023. The inventory and listings data showed a significant rise, with new listings in December increasing by 13.6% over the previous year, totaling 603 properties. Active listings at the end of December were 3,216 units, a 58.7% rise year-over-year. Inventory levels climbed well above historical averages, with months of inventory rising to 5.2, compared to 3.6 in December 2023. Despite these gains, Paultan emphasized that supply remains a critical issue, limiting affordable options for many buyers. He noted that while the improving market conditions are encouraging, the supply must be sufficient to meet demand. This ongoing supply challenge continues to be a significant factor in the Ottawa real estate market. Canada is currently facing a significant housing challenge, as highlighted in a recent report from the Office of the Parliamentary Budget Officer. According to the report, 2.4 million Canadian households are classified as being in core housing need. This figure is expected to rise to 2.6 million by 2027. The report, authored by financial analyst Ben Siegel-Brown and economic analyst Zachary Verhofstadt, examines the federal government's 10-year national housing strategy, initially launched in 2017 in Vancouver. Core housing need, as defined by the Canada Mortgage and Housing Corporation, refers to households whose current housing situation is inadequate in terms of size, quality, or affordability. Specifically, a household is considered in core housing need if its shelter costs, such as rent or mortgage payments, utilities, and property taxes, exceed 30% of its before-tax income, or if the local median cost of adequate housing surpasses this threshold. The report attributes the growing core housing need to two main factors: rising interest rates and the slow adaptation of the housing supply to accommodate increased immigration. These challenges have been compounded by uncertainties surrounding the federal Liberals' national housing strategy, particularly after recent changes in government leadership and the proroguing of Parliament. Developers who have benefited from low-cost loans under this strategy are now facing an uncertain future regarding the continuation of such financial support. Despite these challenges, the National Housing Strategy aims to remove 530,000 households from housing need by the fiscal year 2027 to 2028. This goal is being pursued through various initiatives such as rent subsidies, sustaining community housing, and direct support for construction and renovation projects. Programs like the Rapid Housing Initiative have been launched to address these issues, although the report indicates that more than 926,000 additional households are expected to fall into core housing need by 2027 compared to when the strategy was first implemented. The report also highlights the impact of rent increases, particularly for new tenancies. According to the Canada Mortgage and Housing Corporation's latest rental market survey, rents for turnover units rose by 24.1% in 2023. This increase is largely driven by the lag between rising demand from immigration and the corresponding increase in housing supply. The report suggests that planned reductions in immigration from 2025 to 2027 may help alleviate some of the upward pressure on rents, partially mitigating the impact of these increases. In terms of financial commitment, the National Housing Strategy involves an average annual expenditure of $6.1 billion on programs to improve housing affordability. This represents a 50% increase in federal spending power compared to the previous decade. A significant portion of this spending is directed towards the Canada Mortgage and Housing Corporation's financing for housing programs, which have seen a $1.3 billion annual increase in funding. The ongoing challenges in Canada's housing market underscore the need for continued collaboration between government levels and the private sector to ensure adequate housing supply. As Kristen Devaney, Chief Financial Officer of PCI Developments, noted, the financing programs under the National Housing Strategy have been crucial in enabling rental housing development at below-market rents. Any uncertainty regarding these programs could pose additional risks and challenges to new housing projects. In conclusion, while Canada's National Housing Strategy has made strides in addressing housing needs, the increasing number of households in core housing needs signals that more work is required. With the federal strategy's future uncertain due to political changes, stakeholders must remain vigilant and adaptive to ensure housing affordability and availability for all Canadians.